today we're very fortunate to have Todd Goldman with us. Todd is the managing director for Lazier Capital. Thank you for joining us today.
Thank you, Paul. Glad to be here.
Absolutely. So let's jump into really what we're here to talk about, and that is ESOPs. And what I think it would be helpful for people. What exactly is an ESOP for those that don't fully understand at this point?
Yeah, I mean, the funny thing about ESOPs, and I've been doing M&A for 20 years post MBA school. I was at two big banks and really was doing very traditional investment banking work, third party, large corporates and private equity firms, capital raising and M&A, and M&A was probably 80-20 sell side versus buy side. And the sell side work was really running auctions. You get hired by a seller and you run an auction, you run a competitive process, and you bring in multiple buyers. ESOPs are the ESOP process. It is a third-party sale. There is a market price that is determined, but the buyer is a trustee who manages the ESOP. And what an ESOP is a defined contribution plan. It's a retirement plan. It's governed under ERISA law. The Department of Labor oversees the plans. And it's a retirement plan. Typically, it's a benefit added onto a benefit scheme that a company may have. So you've got standard compensation package of base, sometimes bonus, or in the case of hourly workers, maybe there's overtime and holiday pay, that kind of stuff. We're obviously healthcare is a big one. You've got 401k and the sort of ESOP is typically an extra thing that's added on. And it's a way for closely held companies to sell their company to their employees using the very generous provisions in the tax code. And again, it's a defined contribution plan governed by ERISA. And that's really what it is. It's not very well known. And I think that's, I started this whole part of the conversation talking about kind of traditional M&A. Everybody has an idea what that is, I think.
Sure.
A good metaphor is, selling your house. You hire an agent, you list your house, you look at comparables, you set a price, you bring in a bunch of buyers, you negotiate with one buyer, you close.
Right.
But a lot of people don't know what an ESOP is. And we find that if we're able to have a conversation with a founder owner, closely held business and say, hey, there's another way to do this, right? You can clear your chips, but you can preserve the legacy of your company, you can sell to your employees, and here's how it works. And you're going to get a full economic price. We tend to see a very high hit rate of owners that are interested in this option.
Absolutely.
It's available to C Corps and S Corps, so not uncommon to do a reorg prior to executing transaction. Not available to LLC, so you got to be an S or a C. And there are different dynamics if you're an S or a C in terms of taxability and things that we don't need to get into right now, but yeah, it's really it's not a well-known option. And in the ESOP community, there's a small group of transaction professionals like me, or trustees, valuation firms, attorneys that understand how to put ESOPs together, banks that lend into ESOPs. It's a small group, and we proselytize because it's something people ought to know about.
Absolutely. Well, it's funny. I worked for an ESOP many years ago, and we have a few clients that are ESOPs. And I will say this, that when I worked there and for what I witness today with our clients is the employees do care that little bit more because they are an owner of the company, and it matters. They almost see everything they do on a daily basis as contributing to their own retirement or their own wealth, and as they should. So it's pretty unique, and I think that's a real advantage, let's say, to and a multi-generational owner like we work with. A lot of our folks are multi-generational family-owned businesses because they can stay connected and they can see it thrive in the future rather than selling it and then kind of being done with it. So, I think that's kind of like why someone should care about it. But could you expand on that? Because you've seen it firsthand multiple times of why an owner that has had the business for quite a while would want to see it in this type of format being sold.
Yeah, no, that's a great sort of segue into the next concept here, which is, why do people choose this as a way to transition the business, right? I mean, everybody gets to a point where they need to clear chips, or
Mhm.
they should, right?
Right.
Most people, they're they're closely held business, their family business, whether it's first generation, they're the founder, or the second generation. Um, and I've sat in that chair, by the way, between sort of investment banking stints at two large banks and then joining this boutique firm. We're based in Columbus, Ohio, but we're national. Um, I also owned a business, a manufacturing business. So
Mhm.
I've been in that chair, signed personally on bank loans, gotten called in the middle of the night from angry customers. I know what that's like.
Yep.
But I also know what it's like to have a lot of your liquidity tied up in a business. So people get to a point where they need to clear chips, but that doesn't mean that's the end of your control or your influence or your connection to the business.
Sure.
And we know a lot of founders, or even second or third generation in a family business. The business isn't just a place where you go to get a paycheck. It's part of your life.
Right.
It
It
means
is.
something to you
Yeah.
on an emotional level. And so we do this whole exploration of goals. What are you trying to achieve? I mean, everybody wants to have, economic security. We get that. That's a given. But what else is important to you? There's no better way to reward your employees, preserve the culture of your business, the legacy, your name on the door. Maybe it's something your grandfather built, or something your mom started, or something you and your wife started. And you want this business to outlast your ownership of it.
Right.
And we'll get into some other things about how there's post transaction control, which is also kind of nice. We sort of call it the have your cake and eat it too
Mhm.
option. But you talked about how does it impact employees. Rutgers University did a study, and it showed the impact that ESOPs can have on the lower wage earners, and of course, it just goes up from there.
Yeah.
Uh,
Absolutely. Yep.
New Belgian Brewery. I don't know if you're familiar with the Fat Tire brand
Oh,
beer.
absolutely. Yep.
It was
I
a
don't drink it, but
long time ESOP. Beer industry loves ESOPs, boutique microbrews. It fits with the culture, and they got what I call the Godfather offer. They just couldn't say no. So the ESOP itself was acquired by a Japanese beverage company, and they had 80 millionaires that were created from that. 80. So
yeah.
not 8, not 1, not just the owner and not just the core management team. 80. I mean, there were people. On the bottling line that had been there for a long time and had accumulated stock,
Mhm.
and they were now worth $1 million.
Absolutely.
That is amazing. So that happens. And the other thing is ESOPs bind people to the business. So you have a professional services firm where you try to an investment bank gets bought, or insurance brokerage, or an architectural firm, or you see a lot of environmental services, engineering firms. They're people, right? Their people are the assets. ESOPs work great because it binds them to the entity. So it's not like, hey, we're going to sell this company from, we're going to sell Spacely Sprockets to Cogswell Cogs, and everyone's going to leave.
Mhm.
And that happens. Um, the ESOP is a way to bind people to the asset.
Right.
And that makes them much stronger. And we have statistics that show that ESOP companies outperform. I mean, you can measure, the S&P 500 or the Wilshire, 1000 or whatever index you want to look at for small cap.
Right.
ESOPs outperform. I have a case study and a presentation that I do because I have the data. It's hard to get data, right?
Right.
But the NCEO, which is the National Center for Employee Ownership, put out this newsletter, and there was a case study on this company in Texas, and they're like, S&P from I'm looking at my stats here, over a 10-year period from 96 to 2006, S&P with dividends return 144%. Their stock went up 5 times.
Yeah.
And the CEO says it's because everyone's an owner.
Absolutely.
And everybody holds everyone else accountable.
I
So
agree.
that was a long-winded answer to your question. Sorry.
No, I agree. I see it, like I said, every day, and I witnessed it myself. As employee benefit consultants, we're often asked to help our clients maximize the value of their health insurance programs, typically meaning help us reduce costs as much as possible while adding value, or not at least taking value away from our employees by raising deductibles and out of pocket and so on. And there's many things we can do in today's environment that save 20 to 30% without transferring that risk to the employee. And, you know, when you think about that for a 300 life company that, you know, is maybe spending a couple $1 million on their health insurance programs, that's $400,000 to $600,000 to their bottom line, their EBITDA, if you will. So I assume, and you've said that you figure out a valuation for these businesses. I'm sure it's based on the same thing it is if you're selling it to the typical M&A model. It's based on a factor or a multiple of EBITDA, correct?
Yeah, it's a little different. I mean, typically, and again, I can speak from experience because I ran auctions as a sell-side banker. You know, we would never know what the M&A market, what the buyers were going to say. Mm-hmm. Just like with your house. I mean, pretty much everybody out there's bought and sold a house, right? So you pull the comps, this number of bathrooms, this number of square footage, updated kitchen, mm-hmm. you know, roof's new, whatever, right. You know. And you say, well, my house is kind of like this, and you know, this is what this sold for is a multiple of square feet or whatever. And you come up with a price, but you really don't know. So if the market's hot, you're going to get asking price. If it's a little soft and maybe the mortgage market's, you know, a little tight, you're going to get less. I mean, we go out to, so in the M&A market, you look at transaction comps. What do companies like mine in the same sector, same size, same geography, similar customer base, you know, so, you know, look at paper and packaging and say flexible packaging converters under 10 of EBITDA. Like, we come up with comps. Well, here are 10 transactions. They traded for 7, 8, 10 times EBITDA, whatever the number is.
Right.
And we look at public comps, right? You look at trading comps. Well, you know, big flexible package, big, you know, diversified packaging comes Sunoco, whatever, that are completely ridiculous because frankly, you know, the middle market is, you know, call it, you know, our typical client is 2.5 to 3 of EBITDA on the low end and probably 20 on the high end.
Right.
I mean, it's rare we go above 20. We really don't go below 2.5 to 3 because there are costs associated with setting up an ESOP. Mm-hmm. And that's a separate conversation about how those work. But that's, you know, you can't compare most of those companies to a public company, but we would do that anyway. We'd set up the football field. Mm-hmm. These companies trade here. These companies, you know, public markets, private deal market. And then we do probably a discounted cash flow, which is projecting cash flows out and discounting that back at what we call the weighted average cost of capital, very wonky, whack. And then we come up with a combination of those, you know, those valuations. And ESOP is very much DCF driven, so the discounted cash flow. Mm-hmm. So if you're performing well, and we can add back private company expenses. So most companies have things that don't really need to be there.
Sure, right.
Certain perks, country club, cars. Maybe they got, you know, an uncle on the payroll that doesn't really need to be there, not really providing a lot of value. Whatever it is, we can do that. We can add them back. I just did a deal with somebody at a captive insurance company. Mm-hmm. You know, we added back the captive because they were going to unwind it after the ESOP. Right. You come up with a core EBITDA, and you do. The company provides 5 years of projections, and then we put it into our model. Similar model that a valuation firm that's going to be hired by the trustee to run valuation. I mean, we have people that worked at valuation firms at our shop. We know exactly how the sauce is made. So, you know, we run a DCF. And so for companies that are showing strong projections, the DCF is always going to give you the best value. Mm-hmm. So the transaction comps, like private equity uses this concept of TTM, trailing 12 months, multiple of EBITDA. So it's very backward looking.
Right.
And all year they've been dinging sellers on COVID. Mm-hmm. So well, this was because of COVID. Okay, so we'll add back a little bit. So you see this term EBITDAC. So they added the COVID to EBITDA.
Right.
But you know, for us, it's forward looking, more like the equity markets. What's going to happen in the future?
Right.
So if your company is falling off a cliff in 18 months because you're going to lose a big contract, you're not doing an ESOP.
No, exactly.
If you've got a solid company generating cash, you got a good management team, it's going to grow, you're going to get a better value on the ESOP.
Yeah, no, it makes sense. I mean, my wife and I, we own a business, and COVID, you know, certainly hurt us, but I wouldn't expect to get the full value. You know what I mean? It was like, what's going to happen going forward, not what happened in the past. So it totally makes sense to me. You know, I think at least I feel like ESOPs are becoming more popular, and more people are looking at them, as they should. I mean, especially again, if you're talking about a business you want to eat your cake and have it too, or have your cake and eat it too, however you want to say it, type thing. So why do you think that? Do you think that's just because of this inherent, like being able to stay connected and seeing it thrive type of thing? That's what it appears to me.
What we find is that people, particularly business owners, men and women that start businesses or inherit businesses and grow them, it's such a part of their lives.
Yeah,
And when it's not there, they're missing what we call a life of relevance.
absolutely.
How much golf can you play? How many trips can you go on? Now you can't really do anything, frankly, because you can't even go see the grandkids, or you really can't travel. I mean, this is a temporary thing, obviously, with COVID. But I mean, it's very personal for me because we had a family business in the paper packaging space up in New Jersey, and my father, he started a division out of my grandfather's business and built this new business with my uncle. And it was their lives. I mean, he used to go in 7 days a week, not because he necessarily had to, but he wanted to. I mean, he wanted to go in on Saturday and see the weekend crew, and he wanted to know everybody, and he wanted everyone to know he was in it with them as much. He wasn't just a guy sitting in the office as the owner. He was truly involved in everything. Now, he was self-limiting because he was a bit of a control freak. I came out of business school with all my organizational psychology stuff, and I'd say, well, you do this, do that. It's hard to let go.
Oh, absolutely, yeah.
He ended up selling to a European company that he was afraid was going to come into the U.S. market with their deep pockets and compete with him and drive him into the ground. Basically, he said they can outspend me for a lot longer, or they can buy me, vertically integrate. And we were making like the white part on Band-Aids you peel off, siliconized paper.
Yeah, right.
And they made paper, so like much bigger.
Right. Yeah.
So, but he worked. He integrated the business, and then they wanted him to help build out all North America with a new facility and everything. He said, "Yeah, I'm too old for this. I really don't want to work for anybody. And I worked for my dad, but I never really worked for anybody my whole life. I'm not a corporate guy. I don't want to, travel over to Europe and different. They had a plant in South Africa, and like, I thought it was pretty cool, but he just was like, he was done. He was done. He didn't need to do it. He felt like he put his team on good footing, and he left. And it honestly was the worst mistake he ever made. Not economically, but emotionally.
Yeah, right. Just dealing with it.
Took it away from him, and it didn't have to be. He had a great team. I tried to work there when I was younger, and it just wasn't for me. But he had a really good management team, like guys that had been with him for 20 years, and they would have been awesome running the business.
Yeah, it would have been great.
He could have come in 2-3 days a week. He could have continued to mentor his people. He could have kept relationships up with some of the customers he'd known for decades.
Absolutely.
Suppliers. He had a Korean supplier of film. We also siliconized film. I mean, he'd been to Korea 10 times and had, like, these were his friends, these guys from this big Korean company. And it's out of his life. It's gone out of his life. And the moral of and unfortunately, the European who bought it completely killed it. Took all the good things, ruined the culture, put their own systems in place, ruined the culture, ruined the business. Wow. Terrible. So that doesn't happen every time.
No, right.
But we find the life of relevance is a big deal. So this idea that you can preserve the culture and legacy of the business, you can keep control by running the board, but you can clear your chips, which you got to do, right? I mean, smart people, you need to clear some chips because it's just good risk management in life. No,
it makes total sense. Yeah.
The other thing too is I believe, and I don't have evidence of this, but it's more anecdotal. For a long time, we've been governed by this sort of shareholder return mandate, sort of Milton Friedman kind of, sort of framework. Came out of Chicago, called the Chicago School. I believe now, and you've seen people like Jamie Dimon talking about it, stakeholder value.
Right, yeah.
Not just shareholder value, but stakeholder value.
Right.
In ESOPs, there's no better way. Create employee owners, lead businesses in the community. We did an ESOP for a company up in Northern Michigan. They said to us, we couldn't sell this business. They could have sold it was a wood shipper. They made wood chippers, Bandit wood chippers, big company. Could have sold to private equity, could have sold to Toro. Right. They said, Toro will move the factory to Mexico. I said, we won't even be able to go to dinner in town. I mean, they live in a small town. They're the largest employer in Remus, Michigan.
Yeah.
We, like, we'll have to move. Like, people hate us.
Yeah. Right. Well, ESOP made tons of sense for them, obviously.
So they got a great outcome.
Yep.
And
Good.
they got everything. They had their cake and they ate it too. Paul.
Right. Makes tons of sense. Well, I know we're just scratching the surface today on this stuff
Yeah.
because it is a lot deeper. But I think the main message, for business owners, whether they're family owned or not, but definitely if they are, should explore this option because it makes tons of sense. Again, I've witnessed it personally, and I've seen it with our clients. It is a different feel. It really is, and I think it translates into a better customer experience, a better employee experience, everything else. So before we go though, last question is is there anything that we didn't talk about today that someone ought to know about ESOP versus the typical M&A, model, if you will, that we haven't talked about?
I would say don't listen to your buddy at the golf club or at the tennis club or, something you heard, third hand from an attorney, about what an ESOP is and how it works and why it doesn't work. I mean, there's a lot of misinformation out there. So call me, Sear Capital, you can call Paul. Paul can get to me. And we do a lot of spade work in education.
Yeah. Well, I know, for instance, you would have a conversation on multiple ones to make sure it's a good fit for both of you before you went down any road. So
yeah, we have a process. I've got a slide in my initial slide deck. I mean, we do an ESOP 101, which is typically 90 minutes. So we ask, an owners, sometimes they bring their top manager in as well.
Yeah.
Give us 90 minutes. We'll walk you through an ESOP. If you're still interested after that, then we'll do what's called a feasibility analysis. And we'll spend 3 or 4 or 5 weeks. We'll ask you a bunch of questions, ask for information. We'll sign a non-disclosure. And for free, we'll do a workup. I just sounded like the knife guy on midnight television. Now, people charge for this. It's called the feasibility analysis. There are a lot of valuation firms that'll charge a lot, 25, 50 grand for it.
Oh, yeah.
We don't because it's part of our process. We just want you to be engaged enough to share the information because it's going to take work on your side, but we don't charge for it. We'll roadmap the whole transaction. Then if you're interested, then we'll talk about what a deal would look like and we'll talk about an engagement. And then our engagements, typically it's 4 months. At sell side, M&A is double. Our due diligence process, the trustee due diligence is way different than a normal buyer. And there are a lot of reasons why it's very streamlined. It's very confidential. That's one thing we need to talk about. If you want to clear your chips, this is the only way to do it in a confidential way. If you run a process, information's getting out. If you're selling to a strategic, a competitor, information's getting out. This is totally different. So I would say don't dismiss it before you go through the education. And as an owner, it's worth understanding this alternative. It may not be the right one, but you need to understand.
Yeah, absolutely. I agree. Well, Todd, thank you big time for your time today. Again, I know we're just scratching the surface, but hopefully, we've enlightened some folks that maybe weren't quite as aware of ESOPs and how they work and why they're important and why it might be the best solution for them. But again, thank you for your time and go Spiders.
I was going to say that, but I'll just second that. Go Spiders. I'm excited to see Richmond and Dayton playing hoops. I live in Columbus, which is like an hour from Dayton. So,
awesome.
So yeah, thank you, Paul. This was great.
You bet. Take care. Thank you.